Welcome to the Deep Dive, the Talk Tickers edition. Today, we're cutting through the noise. We're really digging into the Q3 2025 earnings call from Weatherford International. That's WFRD for you ticker watchers. Big player in oil field services. They dropped their results pre-market October 22nd. And our mission really is to filter all that data, the management talk, the guidance, and just give you a clear picture of where they might be heading into 2026. You need to listen because, well, their whole strategic shift, it has ripples across the industry.
Yeah, and context is so important here, especially for you listening. I mean, heading into this call, WFRD had some serious momentum. The stock was up, over 22% in the last 3 months.
Pretty strong.
Very strong, especially when you think about the background noise, right? Pricing pressure, particularly in the U.S. land market, just general market softness. So there was definitely some tension. People wanted proof that this momentum wasn't just, luck of the cycle. They needed to see structural change.
Okay, so let's dive right into those results then. It looked like, well, kind of a mixed bag initially, but the market seemed to like it in the end, nudging the stock up. What were the big numbers for Q3?
Well, the top line, the revenue, that gave investors something to feel good about. Weatherford pulled in $1.232 billion. That actually beat the consensus, which was around $1.17 billion. So about a 5% beat there.
Okay, better than expected.
Right. And it shows sequential growth, about 2% up from Q2. Now, the caveat, and you have to note this, is it's still down 13% compared to last year. So that tells you, the market environment year over year is still tough.
Right. 13% down year over year is significant. Okay. So a beat on revenue, maybe against lower bars, but what about the profit side? That's often where things get, let's say, complicated in this sector.
It did for a second. GAAP earnings per share, the EPS number, came in at $1.12. It actually missed the street's range. They were looking for something like $1.15 to $1.18.
Okay. So that's the miss.
That's the miss. But management very quickly pivoted the conversation. Yeah. Right to margins. Adjusted EBITDA was $269 million. And that got them a 21.8% margin.
21.8%? Wow. Okay, that is a pretty hefty number for oilfield services.
Yeah.
What does that expansion, you said 74 basis points sequentially, what does that really signal? Especially since revenue growth wasn't exactly, booming.
It signals that management is laser focused on what they promised. It's margins first, cost control first, not chasing every bit of market share if it hurts profitability. Getting that 74 basis point jump in this kind of soft market. I mean, competitors are cutting prices.
Yeah.
It really suggests Weatherford's controlling what they can control, the internal stuff.
Right.
It kind of validates all those cost-cutting moves they've been talking about for the past year.
Let's unpack those moves then, because structural change is different from just, tightening the belt cyclically. How exactly did they boost that margin?
It's really a few things working together. The most obvious one is headcount. Since Q3 last year, they've cut over 2,000 positions. 2,000?
That's substantial.
It really is. And that reduction, they say, cuts their annualized personnel costs by over $145 million. That's, money that goes straight towards improving the profit picture.
Okay, but layoffs aren't always sustainable long-term if you cut too deep. Are they backing that up with tech? Rewiring how they actually work?
Absolutely. That's the key part. The cuts go hand in hand with a pretty major tech overhaul. They talked a lot about this big cloud-based ERP system they're rolling out, enterprise resource planning.
Right, the backbone systems.
Exactly. It's meant to automate stuff, integrate everything globally, buying things, managing inventory, all that. Plus, they're pushing shared services, using more automation, even mentioned generative AI for back office productivity. So the idea is you cut staff, but you make the remaining operations way more efficient with tech. It's meant to be a permanent improvement.
Okay, that makes sense. Structural focus, helping the P&L. But cash is always the name of the game in OFS. How's the balance sheet looking? Liquidity, especially after all this restructuring.
Health is looking pretty good, actually. Q3 adjusted free cash flow, FCF, was $99 million. That was on CapEx of $44 million. Maybe trending a little towards the low end of their target range, which is 3 to 5% of sales. Acceptable, but maybe not a home run.
Okay.
But liquidity, that's very strong. About $1.6 billion available. And their net leverage ratio, its debt relative to earnings, is pretty comfortable, around 0.5 times.
You mentioned XCF was maybe at the lower end. Did management point to anything specific holding back cash generation? I think I remember something about Mexico and working capital.
Yeah, you nailed it. That was a clear drag they highlighted. Ongoing problems collecting cash from a, quote, key customer in Mexico. This actually pushed their net working capital efficiency metric up to 29.6%. It was 26.7% in Q2.
Okay, hang on. Net working capital efficiency rising is bad for cash, right? Explain that for listeners.
Right, exactly. Sounds counterintuitive.
Hmm.
But when NWC efficiency as a percentage of sales goes up, it means more of your cash is tied up in things like receivables money owed to you or inventory. So in this case, it went up because cash got stuck. That payment from Mexico didn't come in during the quarter. It became a receivable on the balance sheet instead of cash in the bank.
Got it. So cash was trapped, which actually makes that margin improvement even more impressive if they were fighting that headwind. Okay, let's shift to what you called the financial masterstroke, the debt management side. What exactly did they do there?
They made some really decisive moves to essentially de-risk their future. First, they beefed up their credit line, the revolver, added $280 million, taking the total to a nice round $1 billion.
Okay.
But the bigger piece was a major debt refinancing. They announced $1.2 billion in new notes, paying 6.75% interest, due way out in 2033. And they used that to basically buy back their older notes that were due in 2030.
So pushing the maturity wall way out.
Exactly. Pushes it out by 3 years. And crucially, they estimate this will save them around $31 million a year in just cash interest payments.
31 million a year is definitely helpful, but let me push back a bit here. Locking in 6.75% interest for, 8 years out to 2033? That seems kind of high, doesn't it? Are they worried about rates staying high long term, or was this just the price they had to pay to get rid of that 2030 maturity and maybe get those rating upgrades?
That's a fair question. Look, 6.75% isn't cheap money, but my read is they saw a window to guarantee stability. And getting those credit rating upgrades was huge validation. They got bumped up by Moody's, S&P, and Fitch.
Okay, so the agencies liked it.
They did, because that certainty in this kind of volatile sector is worth a lot. It takes that 2030 deadline completely off the table. It basically transforms their balance sheet into like a fortress. Now they can focus 100% on running the business, investing in tech, and not have to constantly worry about refinancing looming over them. The market really values that kind of stability.
Okay, makes sense. Let's pivot to the markets themselves. With all this internal fixing going on, where is the business actually coming from? Where are they still feeling the pinch?
Yeah, the pressure points are still, the usual suspects, North America, especially U.S. land, that continues to be soft. And they were pretty explicit about seeing pricing pressure in some parts of the Middle East, too. So competition globally is still pretty intense.
But you mentioned Mexico earlier as a drag on cash. It sounds like there was some positive news there, too, though. Didn't that situation improve somewhat?
It did. That was a key point. Revenue in Mexico actually grew 10% sequentially from Q2. And management said they're seeing relative stability there now after a couple of quarters working on operations. But the really big news came after the quarter ended.
Okay.
They confirmed they finally received the first payment from that difficult customer since way back in early 2025.
The cash finally flowed.
Exactly. That's huge. It immediately starts to unwind that trapped working capital problem we talked about, and it gives them and investors a lot more confidence about future cash flow from that region.
Okay, good news from Mexico eventually.
Yeah.
Which other regions are pulling their weight, providing the growth?
They called out a few bright spots. Brazil was a big one.
Mm-hmm.
They landed a big contract there, $147 million over 3 years for tubular running services.
Nice win.
Yeah. Also, North America, offshore, surprisingly strong. And then Kuwait, Oman, and Iraq. They also gave an interesting longer-term view on Saudi Arabia, said it's soft now, but should kind of bottom out soon. And they're hoping for year-over-year growth to come back in the second half of 2026, mostly driven by gas projects there.
Okay, interesting. Now let's talk innovation. We touched on the ERP system, but they seem to be making a really big push into digital stuff, which could fundamentally change how capital intensive they are, right?
Yeah, this is probably the most potentially transformative part of their story right now. They had this FWRD 2025 conference recently, apparently unveiled over 20 new products or upgrades.
Okay.
But the headline grabber was this new platform called Weatherford Intelligence. It's pitched as an AI-driven system, works at the edge, meaning right there at the well site, and it's designed to automate decisions.
Okay, Weatherford Intelligence, AI at the well site. Why is that so important strategically for them?
Because it's fundamentally different from their traditional business. It's capital light. It should be margin accretive. Think about it. Traditional oil field services means buying tons of expensive equipment, trucks, tools, lots of people out in the field. Very capital intensive.
Right, lots of steel in the ground.
Exactly. But with AI-driven digital services, you're selling software, algorithms, expertise that automates things, often remotely. It just doesn't require the same massive capital outlay for the revenue it generates. It shifts their business mix more towards high margin, potentially recurring revenue. That could be a huge advantage down the line.
Got it. Less steel, more software. Okay, so let's connect all these threads, the margin gains, the cost cuts, the tech pivot. What's the outlook? What did management actually guide for Q4 and looking into 2026?
Okay, Q4 guidance kind of reinforces that margin focus. They're targeting revenue between $1.245 billion and $1.280 billion. Adjusted EBITDA expected between $274 million and $287 million. So continued margin improvement baked in there.
And cash flow for Q4, especially with that Mexico payment finally coming through.
Yeah, on free cash flow, they guided basically flat to maybe slightly up from Q3's $99 million. They actually put a number out there saying $100 million should be the floor. But, and this is key, they stress that if those Mexico payments keep coming in regularly, FCF could be, quote, significantly higher than that floor. So some potential upside there.
Okay, cautious guidance, but with potential upside. What about the bigger picture for 2026?
They painted 2026 as that classic tale of two halves. First half, they expect it to be softer, tough year-over-year comparisons, maybe some lingering market pressure, seasonality.
Okay, manage expectations early.
Right. But then they're forecasting significant improvement kicking in during the second half. That's when they expect those offshore and international markets, especially Saudi gas, to really start firming up. And their big goal, they called it their North Star, is getting free cash flow conversion well above 40% in 2026, with a long-term structural target of 50%.
Okay, hold on. Free cash flow conversion. Let's define that quickly for listeners. And why is 50% such a big, ambitious number for an OFS company?
Right. FCF conversion. Basically, it's how good a company is at turning its reported profit into actual spendable cash. You usually calculate it as free cash flow divided by either net income or adjusted EBITDA. For a company like Weatherford, historically very asset-heavy, very cyclical, CapEx is always a big number.
Always spending money to make money.
Exactly.
Yeah.
So getting to 50% FCF conversion, meaning for every dollar of profit, they actually generate 50 cents in real cash after all spending that is extremely ambitious. It signals massive operational discipline, successful cost control, efficient capital spending. It basically says, look, the combination of lower interest, needing less CapEx because of digital, and higher margins is fundamentally changing our ability to generate cash.
So the narrative is set. Be patient through early 26 because the payoff could come big in the second half. And the CEO sounded pretty confident, right? It said he's never been more excited about Weatherford's future, citing the balance sheet, costs, tech.
Yeah, the conviction was definitely there in the commentary.
Okay, which brings us inevitably to our speculative segment. This is not financial advice, part of our deep dive. Given this quarter, discipline, strong margins, aggressive goals, if you had to pitch something outrageous, but, plausible, to a high-risk committee, what's the trade idea?
Okay, here's the pitch. We're going long WFRD 2027 digital delta call spread.
Whoa, okay, break that down. WFRD, we know, call spread. Digital delta. What's that mean in plain English?
Okay, a call spread is basically a way to bet on the stock price going up significantly by a specific date in this case, sometime in 2027. But you structure it using options to limit how much it costs you up front. It's a leveraged bet on upside.
Okay, leveraged bet on the stock going up by 2027. What makes that plausible?
The plausibility comes from everything we just talked about. They've seriously de-risked the balance sheet, extended debt maturities, cut interest costs $31 million a year. They're clearly shifting to these capital-light, higher-margin digital and AI things. And importantly, the stock still looks relatively cheap compared to peers. So that whole 2H 2026 recovery story, if it happens, the stock could really move.
All right, that sounds reasonable enough. So where's the outrageous part? What's this digital delta?
The outrageous part, the digital delta, is betting on why the stock goes up so much. We're betting that the combination of that fortress balance sheet, the new AI tech platform, and hitting that 40%, maybe even getting towards 50% FCF conversion target, makes Weatherford an irresistible takeover target.
Yeah, an M&A play.
Exactly. The outrageous bet is on a strategic M&A premium sometime in late 2026 or early 2027. Think about it. If a bigger competitor wants to instantly buy a de-risked financial profile and a cutting-edge tech platform without building it themselves, WFRD becomes the prime candidate, maybe the only candidate left with that combo. Hitting those massive FCF numbers provides the valuation justification for a huge buyout premium. So the call spread is the way to play for that big, potentially binary M&A outcome. That's the digital delta we're betting on.
Betting that discipline plus technology equals a buyout. That's definitely an outrageous but plausible way to look at it. A fascinating end to a really strategically dense quarter for them.
Yeah, to just wrap it up, the core message from Q3 is their strategic pivot seems to be working. They beat on revenue, they boosted margins even with market headwinds, and they nailed the debt management. That gives them a ton of resilience now, positioning them structurally for whenever that international market really kicks back into gear.
And the final thought may be, for you, the listener, chew on, Weatherford's story isn't just about oil prices anymore. It feels like it's much more about execution. How quickly can they actually implement all this internal change, the ERP, the automation, the AI, and can they really turn that efficiency into that super ambitious 50% FCF conversion target? If they pull that off structurally, the stock could fundamentally re-rate, almost regardless of the day-to-day noise in the oil market.
And just the standard reminder, everything we discussed today is purely for informational purposes. It is definitely not investment advice. Please always do your own research.
Absolutely. Well, thanks for joining us on this deep dive into Weatherford International. We'll catch you on the next one.